$76.42. That is what the screen says. And that screen, I want to suggest to you today, is lying. There is a particular kind of intellectual arrogance that masquerades as financial sophistication. It is the arrogance of a man who watches the ticker and believes he has therefore understood the market. He has not. He has watched the shadow on the wall and concluded he has seen the fire. The silver market in the spring of 2026 is one of the most consequential illustrations of this confusion that this generation of investors will ever have the misfortune, or the extraordinary fortune, of witnessing in real time. Let us begin where all serious analysis must begin, with arithmetic. As of this Saturday, the 25th of April, 2026, spot silver is trading at approximately $76.42 per ounce on the COMEX July contract, recovering modestly, up 1.38% from a sub-$75 intraday print on Friday the 24th that placed the metal on track for a nearly 7% weekly decline. That decline was driven, as financial journalists dutifully reported, by Strait of Hormuz inflation anxieties and by the near-zero probability of a Federal Reserve rate cut at the April 29th meeting. The gold-silver ratio sits at approximately 61-1. Gold itself, for reference, is trading near $4,720 per ounce after its own weekly pressures, having retreated from record highs set earlier this year. Year on year, silver is up 131% from the same week in April 2025. These are not contested figures. They are the market's own testimony about itself. Now let us consider what the market is not saying out loud. COMEX registered silver inventory, the metal-carrying warehouse warrants that is immediately and contractually deliverable against futures contracts, stands at approximately 76.88 million ounces. Against that physical reality, the May 2026 silver futures contract carries open interest representing 173.2 million ounces, with 34,641 contracts still outstanding a mere 4 business days from first notice day. The coverage ratio, the percentage of outstanding paper claims that registered physical inventory can actually satisfy upon delivery, is 13.4%. Paper leverage sits at 7.2 times. There are 7.2 paper claims for every single physical ounce that can be delivered. This is not conspiracy. This is not conjecture. This is the CME Group's own published warehouse stock report, and it is describing a structure that a sober-minded Victorian railway engineer would immediately recognize as a bridge that has been designed to carry far more weight than the underlying steel can bear. The historical precedent for what happens when such arithmetic meets a delivery test is worth examining with care. On the 22nd of January, 2026, the single most extreme weekly withdrawal in the modern COMEX data series occurred. In 7 calendar days, 33.45 million ounces, approximately 26% of the entire registered silver pool, were removed in one motion. The cable commentary desk that week was largely occupied with Iranian peace negotiation headlines and Federal Reserve policy speculation. They devoted, to the best of available recollection, essentially no time to the physical delivery mathematics that had just produced the most dramatic registered inventory collapse in the exchange's recorded history. China did not merely restrict silver exports. What Beijing's Ministry of Commerce enacted, effective January 1, 2026, was architecturally more deliberate than that casual description implies. China replaced its prior quota arrangement with a 2-year special government licensing framework, effective through the entirety of 2026 and 2027, that elevated silver to the same strategic export control classification as gallium, germanium, and rare earth elements. Under this framework, only 44 companies qualified for export authorization. The qualification criteria are not incidental: a minimum annual export capacity exceeding 80 metric tons, and a minimum credit line of $30 million. Requirements that, by design, exclude the overwhelming majority of China's silver refiners and trading intermediaries from the global export channel entirely. Against this backdrop, China had exported more than 4,600 tons of refined silver in the first 11 months of 2025, a volume now subject to licensing restrictions capable of diverting the preponderance of that flow to domestic industrial consumption. The consequence materialized almost immediately. On the 2nd of January 2026, while the most actively traded COMEX March contract was closing at $72.26, the lowest available price for a single 1-ounce silver coin in Dubai was $99.93, a premium of $27.67 on equivalent metal. Two Chinese manufacturers and a major Chinese trading firm simultaneously contacted Canadian silver producer Kuya Silver, offering to purchase physical silver at 8 to 10% above prevailing market prices. The physical and paper silver markets were, on that single day, not two windows into the same market. They were describing two different realities about the same scarce material. The third fracture in this structure is maritime and geopolitical, and it has been reported accurately in the narrowest factual sense, while being almost entirely misunderstood in its market consequence. The Strait of Hormuz has been effectively shut since late February 2026, when U.S. and Israeli air operations against Iranian targets prompted the Iranian Revolutionary Guard to begin boarding and attacking merchant vessels and mining the waterway. Ship transits collapsed from approximately 130 per day in February to approximately 6 in March, a 95% reduction. On April 12th, the United States formally announced a blockade of vessels attempting to transit the strait, creating what analysts have characterized as a dual blockade, with American naval forces restricting Iranian port access and Iran simultaneously restricting international commercial passage. The effect on silver is not, as cable coverage has implied, a simple inflationary headwind. It operates through two distinct and compounding channels. The inflation channel, where elevated diesel and power costs directly raise the all-in sustaining costs of every primary silver mine on the planet by 15 to 25% of their operating budgets, and the physical routing channel, where ocean carriers have suspended service resumptions, with projections holding that normalized transit will not resume for a minimum of 6 months, extending transit times and war risk insurance costs for every silver bar moving from Asian refiners toward London or New York. This is not a silver story wearing a geopolitical costume. This is a geopolitical story with silver wiring running through its walls. If this analysis is connecting dots the mainstream commentary has left scattered across separate desks, if you've found data here that you couldn't find elsewhere, do something about it right now. Hit the subscribe button. Ring the notification bell. Because what is coming in the next 4 business days, the next 80 days, and the next 6 months is not going to be reported in the order it deserves, and you will want to be in this chair when it lands. There is a document sitting in the Federal Register that the silver commentary world has treated with something approaching professional negligence. On the 15th of January 2026, President Trump issued Presidential Proclamation 11.01, bearing the formal title, Adjusting Imports of Processed Critical Minerals and Their Derivative Products into the United States. The proclamation followed a Section 232 investigation conducted by the Department of Commerce's Bureau of Industry and Security. That investigation concluded that imports of processed critical minerals, including silver, which was formally added to the U.S. Geological Survey's critical minerals list in November 2025, alongside boron, copper, lead, silicon, and uranium, threatened the national security of the United States. The president concurred. Rather than imposing immediate tariffs, Proclamation 1101 directed the Secretary of Commerce and the United States Trade Representative to initiate negotiations with trading partners and report back on negotiation status by the 13th of July, 2026, 80 days from this recording. The proclamation explicitly reserved the authority to impose tariffs, quotas, and minimum import prices on silver and other processed critical minerals if those negotiations are deemed insufficient or are not progressing in a timely manner. Silver is now on the same national security ledger as semiconductor manufacturing equipment and pharmaceutical active ingredients. July 13, 2026 is a live legal fuse, and the outcome of whatever negotiations are quietly underway will determine whether silver faces an entirely new tariff architecture before this calendar year concludes. Let us now consider what 6 years of cumulative arithmetic looks like rendered as a single number. The Silver Institute's World Silver Survey, published April 15, 2026, projects a 6th consecutive annual structural deficit of 67 million ounces for the current year. The cumulative drawdown of above-ground physical silver stock since 2021 has now reached 820 million troy ounces. That figure is the approximate equivalent of 1 full year of global silver mine production, consumed, not stored. Gone from above-ground supply into manufactured goods, into solar cells, into missile guidance contacts, into semiconductor bonding wire, into the server infrastructure of data centers, and not returning. More than 50% of silver demand is industrial and consumed irreversibly. The Silver Institute's 2026 demand forecast includes physical investment demand rising 20% to 227 million ounces, a 3-year high, even as prices remain elevated. Mine supply has plateaued near 813 million ounces annually. New primary silver projects carry development timelines of 7 to 15 years. The market has been drawing down a finite vault since 2021. 820 million ounces is the running tally on that withdrawal. The cable desk has reported it, when it has reported it at all, as a line item in a commodity survey. It is not a line item. It is a structural clock. The iShares Silver Trust, the world's largest silver exchange-traded product, trading under the ticker SLV, held approximately 15,271 tons of physical silver as of April 1, 2026. Total assets under management grew from approximately $13.4 billion at the start of 2025 to approximately $38 billion by year-end 2025, reaching approximately $46.2 billion by February 2026, driven by average monthly inflows of approximately $2.02 billion across calendar year 2025. The 5-day net flow as of the most recent reporting window has turned positive at $52 million, a preliminary signal of institutional re-entry following 3 months of net outflows totaling $1.78 billion during the sharp correction from January's record highs. What SLV's holdings communicate, that the headline price does not, is that the institutional bid for silver exposure has not collapsed even as spot prices fell approximately 37% from the January high of $121.67. That distinction matters. Demand destruction corrections look different from this. Forced selling into structural disbelief looks different from this. The Wall Street institutional forecast range for silver by year-end 2026 is, by any reasonable historical measure, the widest dispersion of professional opinion on any major commodity in recent memory. J.P. Morgan Global Research projects a 2026 average of $81 per ounce, with an implied fourth-quarter high of $85, while J.P. Morgan's more cautious analyst, Marko Kolanovic, has warned publicly that silver could retest $50 if speculative positioning fully unwinds before physical fundamentals reassert. Commerce Bank's Commodity Research Desk forecasts $90 by year-end 2026 and $95 by the close of 2027. The Reuters consensus from the LBMA April Forecaster Survey projects a 2026 average of $79.50. Citi's global head of commodities research upgraded Citi's 0 to 3 month price target to $150, describing silver as behaving like gold squared at the time of the January 29th all-time high note. Bank of America's head of metals research, Michael Widmer, maintains the single widest institutional forecast on the street, projecting silver could reach anywhere between $135 and $309 per ounce before year-end 2026, depending on the gold-to-silver ratio pathway that materializes. Widmer acknowledged the uncertainty directly, noting the price could cap at $309 rather than guaranteeing that level, while maintaining that silver is structurally positioned to meaningfully outperform gold in 2026, regardless of whether the extreme scenario materializes. From J.P. Morgan's $50 bear case to Bank of America's $309 bull case, that is the spread of serious, credentialed, institutionally published opinion on a single market. The reason for that dispersion is not analytical incompetence. It is that the physical and paper silver markets have structurally bifurcated, and different analysts are pricing different outcomes of that bifurcation. The conservative disposition, and I use that phrase in its classical sense, as a commitment to the preservation of demonstrable reality against fashionable abstraction, requires that any honest analysis present the bearish counterargument with the same rigor applied to the constructive one. Silver is trading approximately 37% below its January 29th all-time high of $121.67. The metal recorded a nearly 7% weekly decline in the week ending April 25th, driven entirely by Strait of Hormuz inflation fears, raising the prospect of central bank rate hikes rather than rate reductions. The CME FedWatch tool is pricing zero probability of a rate cut at the April 29th meeting, and the June meeting cut probability is minimal. Sustained crude oil above $100 per barrel, WTI and Brent are currently in the $95 to $105 range, represents a macro headwind that none of the structurally bullish arguments have fully incorporated into their second half 2026 scenarios. The World Silver Survey specifically notes that photovoltaic silver demand is forecast down approximately 19% in 2026, as manufacturers including Trina Solar, Jinko Solar, and Longi compress silver paste intensity through heterojunction copper cord silver substitution. Global industrial silver fabrication contracted in 2025 for the first time since the pandemic. The COMEX stress index, showing 13.4% coverage and 7.2 times paper leverage, does not guarantee a delivery squeeze. The history of elevated open interest relative to registered inventory is long without always producing the specific outcome of a default. Most futures contracts settle financially, not through physical delivery. The bear case is real. It would be intellectually dishonest to present it otherwise. But consider the architecture of what now confronts that bear case simultaneously. 4 business days separate this market from the May 2026 COMEX first notice day. The April 29th Federal Open Market Committee meeting is Jerome Powell's final meeting as Federal Reserve Chair. The CME dot plot currently projects only 1 rate cut in 2026, down from 2 projected at the start of the year, and the confirmation of Kevin Warsh as incoming Fed Chair, a man whose public record includes formal dissent against quantitative easing programs during his prior tenure as a Federal Reserve Governor, triggered the cascade from $121.67 towards $75 in the weeks following his nomination. Warsh has never presided over a physical commodity delivery squeeze in his professional career. The 13th of July Section 232 silver negotiation deadline is 80 days away. The Chinese licensing framework that removed the majority of Chinese silver refiners and trading firms from global export channels is a 2-year structure extending through 2027. The 820 million ounce cumulative deficit is not a forecast. It is an accounting of physical silver that was present in 2021 and is not present now. It will not be replenished by a rate cut or a peace negotiation or a change in monetary philosophy. What history teaches, when one is patient enough to read it carefully, is that commodity markets have a persistent tendency to price the visible and ignore the structural until the structural becomes the visible. In 1980, the silver market's structural realities became visible in a manner that remains, 4.5 decades later, the defining reference point for precious metals market dislocation. The Hunt Brothers episode was extraordinary in its specifics but not in its category. What belongs in that same category, structural supply constraints meeting financial leverage, meeting geopolitical disruption, is not a comfortable observation, but it is a documented one. The 8 data points that constitute the honest picture of the silver market on April 25, 2026, are all verifiable against primary sources. The CME Group Warehouse Stock Report, the Chinese Ministry of Commerce Export Licensing Registry, U.S. Presidential Proclamation 11.01, the Silver Institute Cumulative Deficit Accounting from the World Silver Survey, the iShares Silver Trust Custodian Reports, the Bank of America and J.P. Morgan Institutional Research Notes, the UNCTAD Rapid Assessment of Strait of Hormuz Disruption, and the Federal Open Market Committee's published rate projections. None of them are conjectural. All of them are, to varying degrees, currently absent from the mainstream financial commentary cycle. The screen says $76.42. A COMEX warehouse report, a Chinese Ministry of Commerce registry, a presidential proclamation, a shipping industry assessment, a Silver Institute survey, an ETF custodian report, and 2 Wall Street research desks are each, in their own technical language, saying something considerably more complicated than that. Before you scroll, drop a comment below. Tell me which of these 8 fractures surprised you most. Tell me which one the desk you usually watch covered this week. Because that comment thread is a record, and records, unlike cable cycles, do not disappear when the next headline arrives. The market will resolve the tension between the paper price and the physical arithmetic. It always does. The only genuine question, the one that separates the informed observer from the passive spectator, is whether you understood the structure before the resolution or only after it. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind.